If you're getting ready to buy a house, there's probably one of two things that's on your mind. The first thing is, am I buying a piece of crap property that's going to be a headache for years to come? If that's the case, you want to check out my video on home inspections that I've linked in the description below. The second thing you might be worried about is, how am I going to afford this house? This is a huge chunk of money, and I don't have $400,000 just lounging around in my bank account. Well, in this video, I'm going to cover 5 different types of loan products that may be helpful for you as a first time or a next home buyer, as well as the pros and cons of each. Now, each of these loan products are not for everyone. And in fact, some people are going to be automatically disqualified for them just based off of their prior work history. But if you're ready to learn about all 5 of these loan products, follow along and let's jump in to talk about money. For the first type of loan, let's go ahead and talk about my favorite loan of all time, which is the VA loan. The VA loan, unfortunately, is not for everybody because you must have either been a veteran or an active duty service member in order to qualify for this loan. Now, one of the reasons I love this loan is because you can use it to buy your first house or your next house with 0 money down. That is a huge benefit. And on top of that, usually the interest rates are a little bit lower than a conventional loan, so you get the added benefit of that as well. The credit score requirements for this one are flexible and are usually dependent on the lender, but typically if you have a credit score of around 620 or above, you should be good to go. Now, as far as PMI is concerned, which is private mortgage insurance, the VA loan has $0 of PMI. And that's because the VA charges you a funding fee in order to mitigate some of their risk in case you default on your loan. That being said, because you don't have that PMI, you do still have to pay that VA funding fee, which can be anywhere from 0.5% to 2% of the loan amount. It just kind of depends on your lender. Now, this funding fee can be a pretty sizable chunk of money, maybe up to $10,000, $15,000, or $20,000. But the good news is that you can roll that into your loan balance. So it means even less money comes out of pocket. Now, I have to warn you about something here because I've seen this over and over and over again. If you're buying a house with a VA loan and you put 0 money down and you roll that funding fee into your loan, that means that you are buying a house with negative equity. You're buying a $300,000 house for $312,000. That means you owe more on the house than the house is actually worth. This may not hurt you if you're planning on staying in the house for 5, 10, 15 years, but if you're planning on moving again after this tour or just in a couple of years, that could definitely bite you in the butt. So make sure that you're thinking about your long-term plans before you put 0 down with a VA loan. While I'm on the topic of VA loans, there used to be a stigma about VA loans being harder to close or less popular or not as good for sellers, but that's something that I just haven't seen. Granted, I am in Charleston, South Carolina, where there's a ton of military here and there's a lot of VA loans that are used. Maybe that just has more to do with the locale than with actual buyer and seller sentiment. But in any case, if you can take advantage of a VA loan, you absolutely should. Now that we've covered VA loans, let's talk about another government-sponsored option for primary residence homeowners, which is the FHA loan. Now, an FHA loan is a loan that is backed by the Federal Housing Administration, hence FHA, and it's great for first-time home buyers or for people with low income and low credit. The down payment is going to be very low on this type of loan because it's backed by the federal government, and the down payment can be as low as 3.5% or 3%. Now, that may sound awesome, but there are other types of loans that have a similar low down payment that may be a better fit for you. Now, one of the downsides of an FHA loan is that you do have PMI, and that PMI stays for the life of the loan. So even if you meet the equity requirements where the value of the house is greater than the loan balance, so even if you meet the requirements to drop that PMI off of your mortgage payment, it doesn't matter with an FHA loan. You're still locked in for that PMI or for the life of the loan. Now, there is one benefit to an FHA loan that I need to bring up, particularly for those of you who are looking to negotiate and put even less money down than you thought you could. The tip here is that every type of loan that is conforming, meaning the government will insure it to some degree, has a limit on the amount of seller paid concessions that can be used for the loan. For a VA loan, a conventional loan, and a USDA loan, which I'm going to cover next, all 3 of those loans have a cap on the amount of seller concessions that equal 3% of the purchase price. Here's the kicker. With an FHA loan, that 3% doubles to 6%. So that means if you're purchasing a home with an FHA loan, now you can get the seller to pay up to 6% of the purchase price toward down payment, closing costs, a rate buy down, whatever it may be. That can be a huge advantage, particularly for someone who's looking to come out of pocket as little as possible when they're buying the next home. I hinted at it already, but our next loan is the USDA loan, which stands for United States Department of Agriculture loan. The USDA loan is kind of a hidden gem because it's also one of the loan programs that gives you the opportunity to put $0 down if you're buying a primary residence. There are definitely some catches though. A USDA loan has to meet the requirements and you have to be in certain locations, mostly a rural or an agricultural area. Now, sometimes you can use a USDA loan to purchase a house that's just kind of on the outskirts of town to where it doesn't really feel like it's super rural, but you want to make sure to verify with your lender that the property does actually qualify for this type of loan before you go putting in an offer stating that you're going to use that type of loan. As far as your credit score goes, and that 620 or 640 credit score is going to be a little bit higher than the requirement for an FHA loan, which is sitting around 540. Now, USDA loan does have PMI, but the USDA loan's PMI is not as high as the FHA loans. And once you meet the equity requirement, it does fall off of your mortgage payment. If you've got your eyes on a house and you're wondering if the property will qualify for USDA loan, you can just go to usda.gov and search for USDA loan products there, and you'll be able to find a map where you can verify that the property does actually qualify. So far, we've covered 3 different types of loans that are all guaranteed by the government. Those are the VA loan, the FHA loan, and the USDA loan. Now let's talk about the good old bread and butter of the real estate world, the conventional mortgage loan. The conventional mortgage typically requires 20% down if it's an investment property, but if you're going to use the loan for a primary residence, you can get as low as 5 or even as low as 3% down on your mortgage. Now, a conventional loan is going to come with PMI, but that PMI can and will fall off once you meet the equity requirement. And that equity requirement is that your loan balance has to be 80% or less of the value of the home. This loan is great for buyers who have a strong credit score, solid income, and who may have a little bit more money to put down to get into their first or their next home. There is a loan limit here, which is listed on the Federal Housing Administration's website, and it's usually broken down by county. Now, conventional loans, while they do turn a lot of people off, I actually like them a lot because they do provide a lot more flexibility. It's usually a little easier to close. There's not as many stringent requirements on them like a VA or an FHA loan may have. And pretty much any lender is going to be able to underwrite and fund a conventional loan, no problem. Now that we've covered 3 types of government-backed loans and conventional loans, let's talk about a type of loan that got a really, really bad rap, and rightfully so, in the 2007 to 2009 financial crisis. We're talking about an ARM, which is an adjustable rate mortgage. Now, I know as soon as I say ARM or adjustable rate mortgage, a lot of people are going to freak out and be pretty upset about this because ARMs historically have been a very, very bad idea, right? With the other 4 types of loans that we've talked about, your interest rate is fixed for the life of the loan. That's something that's unique to the United States that a lot of other countries just don't have. But with an ARM, your interest rate does vary. And the type of variance and how much it can vary is going to depend on the type of adjustable rate mortgage. Typically, you're going to see an ARM that's called a 5-1 or a 7-1 or a 10-1 ARM. That just means that the rate is going to stay constant for the first period of time, and then it can go up or down by 1% each year after that. So for example, if you have a 5-1 ARM, that means that for the first 5 years, you have a set interest rate, but then after those 5 years are up, your interest rate can go up or down by a maximum of 1% each year. Now, while you are introducing a lot of volatility here because you don't know what rates are going to do in the future, there is some benefit because your interest rate at the current time is typically going to be a little lower than a fixed rate mortgage, right? This is the trade-off that you make if you're going from a fixed rate product to an adjustable rate product. That being said, if you are looking to get an ARM on your first or your next property, you need to make sure that you can support the higher interest rate if the interest rate does go up over the next several years. I've seen a lot of people get into hot water, including the entire US economy, when a lot of these adjustable rate mortgages all adjusted at the same time, and then people ended up not being able to make their mortgage payment and falling into foreclosure. A lot of times, the only people who are going to find ARMs attractive are going to be investors or house flippers or buyers who know that they're going to be moving within the next 3 to 5 years. So they're not worried about the long term downstream consequences of having an interest rate that could change after 3, 5, or 7 years. That being said, I almost always recommend going for a fixed rate mortgage because it's just one more piece of risk that you can take off of your mind and off your plate. At this point, we've talked about 5 different loan products, and you're probably wondering which one's for you. So here's the quick cheat sheet. If you're a veteran or an active duty service member or the surviving spouse of a veteran or active duty service member, you got to use the VA loan. That is a phenomenal product with a lower interest rate and possibility of zero down to get into your first or your next home. Now, you do have to use this loan on a primary residence. You can't use it to build your rental property empire. If your credit score isn't great and or you have a little bit lower income, then an FHA loan is going to be the way to go. Now, keep in mind, you are stuck with PMI for the life of the loan, but the trade-off for that is that you can have up to 6% of the sales price in seller concessions covered for you as a new buyer. If you're in a rural or an agricultural area and you want another zero down loan option, then the USDA loan is going to be a phenomenal option for you. Anyone who has a 5 to 20% down payment and a strong credit history can't go wrong with a conventional mortgage, especially if you can find one of those programs that offers as little as 3% down. Although 5% down is going to be helpful in creating a small equity buffer. And then lastly, I don't recommend this for a lot of people, but an ARM, an adjustable rate mortgage, is going to be a potential option for flippers, investors, or anyone who's expecting to move in the next 3 to 5 years. So that's it. That's all 5 loans we want to talk about today. Honestly, the biggest takeaway you can get from this video, apart from a brief overview of the different types of loans, is figuring out that each loan is going to be better for each different type of person. It's totally subjective. Someone might totally balk at the idea of putting zero down because they're like, oh my God, I'm going to be upside down in just a couple of years. Or someone might love the idea of an adjustable rate mortgage because they get a lower rate for now and they know they're going to move. My point being, anytime you're looking to get into a new loan product, whether that's a USDA loan, a VA loan, conventional, ARM, whatever it may be, make sure you know all your options before you sign on the dotted line. If you like this content or you want to see a deep dive on VA loans, check out some of my other videos where I go way deep into the numbers about exactly how beneficial VA loans and other low down payment loan programs are.